Hello, thank you for joining us on the show today. I have Mike Martinek from State Farm Insurance Company. Mike, thank you for joining us on the show.
Yeah, thank you for having me here today, Kamyar. I appreciate it.
So tell us a little bit about your background, Mike.
Yeah, so I didn't have any insurance experience. I opened my State Farm Insurance located here in Calabasas. I'm your neighbor, a couple doors down, right? You like your good neighbor? State Farm is there. September 1st, 2011. I started what's called a scratch agency. So that means no book of business, started from the ground up. And I worked very hard over the last 12 to 13 years to build my brand, build relationships, to become a really strong referral type of industry to grow. Because insurance is all, like most, is referrals.
Right,
you know?
Right. All right, well, you've done amazingly well. You know, my family and I all have our insurance with you, and we're all very happy.
Well, I appreciate your business and your trust because you have choices like everybody else, and that loyalty doesn't go underlooked. I appreciate it.
So tell us what's been going on in the insurance industry in the last 2-3 years, Mike. What have you been facing? What's going on the third world? And what are people actually facing on the other side?
Yeah, it's definitely some challenging times in a lot of industries, especially insurance at this moment. We call it the insurance pandemic because when the real pandemic hit, insurance was actually still really strong and growing. I mean, we were growing by 20 to 30% per year when unfortunately a lot of businesses were closed. So we were capitalizing on that. But now, unfortunately, with inflation, cost of construction, risk has really increased. The Department of Insurance has not allowed the insurance companies to be rate adequate. And the way we do our price modeling, only in California, they restrict us. And when I say restrict us, reinsurance is a huge part of insurance risk and pricing. We're not allowed to price for the cost of reinsurance in California. So think about that. If you have something that's going up, let's say 40% on the back end, but you can't charge up front for it, you're losing money. So for example, State Farm currently, from what I understand, we're losing about 40 cents on every dollar on homeowners. And the reason why is that for the last 5 years, if you're taking on new business, and especially when you're growing more rapid than ever, we've had record-breaking growth the last 3 years in auto and fire side, but you're not charging enough for that risk, that's not a good business model because you're collecting less than what you need to be able to provide when you have to pay a claim, okay. Right? So it all comes down to the Department of Insurance because the insurance commissioner is an elected position in California. Not to talk about politics or anything, but it's a little bit political in the sense that he wants to move up in his career to maybe a governor in the future. So they want to look good to the constituents on keeping price modeling low because you're not going to vote for somebody that raises your insurance rates, right? Mm-hmm. So all of us insurance companies for the last 5 years has been saying to them, hey, there's an issue here. We're underpriced. We need to raise our rates. So what we do is we go in there and we request a rate increase and they deny it. And they say, no, you're profitable as a company. Well, you got to remember, every state has a different risk. And so you can't put it all into one big pool because State Farm is in the entire United States. So if we're profitable in other states, but not in California, he looks at State Farm Mother Mutual as, oh, well, you guys are growing. Well, of course we're growing because we invest our money well as a company. That's what they do with insurance premiums. But in California, we're losing. And so if they don't allow us to change our rates, we're going to continue to lose and then not be able to fulfill our promise. That's what insurance is about, paying on that promise. Right. And so right now we've just been really underpriced like all companies. And so as you know, probably now I would say safely 90 to 95% of insurance companies pulled out of California. You can call it a moratorium. You could put a pause, whatever you want to call it. We're not allowed to write any new business policies here in California. So it puts a bind on people, right? You're in the real estate business and mortgage business. So people need what? Insurance to close a loan, insurance to buy a house. That fire insurance is almost impossible to get, or it's going to come with a price tag that most people are price shocked.
They're not ready to pay.
Not ready, willing, or understanding where it all comes from, right? Because this is why we're here. The education of insurance is what it's about. And most people aren't educated on it. They just go, oh, it's high premiums. I don't want to pay. The insurance companies want to take more of my money. No, we want to take enough money so when you have a claim, we can pay and fulfill and get your house back to where it's state that it was in.
When did the moratorium start for State Farm?
So actually, I remember this date like yesterday, May 27th, we had a meeting at 12 o'clock in the afternoon, corporate, online.
2023.
Yep, this year, 2023. So about 6 months ago. And all of a sudden, we're all in this meeting. We're thinking, oh, maybe a rate increase or something's coming. They just dropped the biggest bomb on us. They said, as of 12 midnight tonight, you are no longer to write any new fire business that falls under what's called our general company. So general company is like homeowners, it's umbrellas, it's commercial auto, it's workers' comp, it's business policies, commercial umbrellas, and so on. So they're like, all of that has to be at a halt. You can only submit applications as of midnight tonight, and it's 1 o'clock in the afternoon on Friday. So they purposely did it so we couldn't put any more business on the books. Based like, okay, wow. And then nobody knows how long, but in order to make these changes, let's be realistic, the DOI, the government, everybody's getting involved, and that takes, probably 18 to 24 months before you probably see any type of change.
So meanwhile, your business is only based on the existing business. So how are the existing clients affected?
Well, this is one of the things that we say, great news, Mr. Customer, right? Great news. And what do you mean great news, Mike? Well, we're not canceling you. We're not non-renewing you. That means we're going to keep your existing business as a client as long as there's not a claims-related new underwriting, stemmed up by claims. So if you're clean, we're going to keep you. And then your rate could change based on the risk of where you're located. But we're keeping our existing clients, not putting on the new fire business. But we are still very strong in writing the auto insurance. We're still able to write new business for auto insurance. We're still able to do new earthquake policies. We can do bonds, things like that. But most of our core products, which is the homeowners, umbrellas, jewelry insurance, commercial umbrellas, commercial auto, we can only add to our existing commercial auto with like added cars, but we're not allowed to take on a brand new customer for new business. So it's all just surviving on the residual income that I worked hard on to build, because that's the power of insurance, is residual income.
Right. And then basically your majority of your business is, customer service, right?
Yeah, I mean, we're definitely in the customer care business, right? We're solidifying and keeping our clients happy, servicing their existing policies and making sure that we're taking care of their payments. We want to make sure that they don't lapse, because if you don't make your payment and the policy goes into cancellation status, if you wait more than 30 days to pay that bill, now it's considered a new application. Now you're not eligible to come back. So State Farm, with us, we're really being very proactive in making sure our customers pay their bills, understand the risk of not paying the bill, and hopefully they can financially pay it. But we've been lucky. We've really been saving a lot of our clients from missing out on getting canceled. And then other companies aren't so lenient. For example, Mercury Insurance, if you cancel by 1 day, the next day you're not eligible to come back. Wow. A lot of companies are like that.
What if there's, a client nowadays, obviously you can't, right? Then, that's going to call you for some advice, just to see what kind of insurance people are offering them. And then are you willing to take the time to, tell them what's out there, what's good, what's bad, what's the entails in the policy?
Yeah, that's a great question. Absolutely. Even though I'm not able to provide a new policy, doesn't mean I'm not available and willing to provide you with a second opinion, my professional opinion. Look at maybe what another broker or company is offering you. Free advice, right? I actually have a tagline. I say, you get a free agent with every policy. Well, even though you're not buying a policy from me right now, you're still going to get me for free to give you that advice, because I want to build a relationship and a trust so you know what you're buying now. But later I can have the opportunity to maybe assist your family when State Farm's back strong on the market again, because we will be. We're not going anywhere. We're number one for a reason. And we're going to continue to just want to build those relationships with our local customers and friends. Like, you have a lot of clients that unfortunately that you refer to me and I can't write right now, but I'm still there to help them. That's the reality. I don't want them to be blindsided by, they're not experts in my field, but I'll be given my expertise to be able to make sure that they understand their options available to them.
What is the difference between an admitted carrier and a non-admitted carrier?
It's like kind of in your industry, right? You have your subprime market that you used to have, and then the prime market, right? So you have your first market, A+ at carriers like State Farm, Farmers, AAA, Geico. You get it, the big names. Then the non-admitted are the high risk, and they're maybe not as highly rated as far as their financial stability, the types of policies that they write. So usually what that means, less coverage, higher deductibles, and probably 5 to 10 times more premium.
Wow.
Yes. Yeah. I'm seeing a lot of that, unfortunately, especially if you're in a wildfire zone, because that's one of the big contributing factors to why we're at today too. This is a huge number statistic. In the last 5 years, all the catastrophic losses that have happened, wildfires, Woolsey, Paradise, heavy rains and storms. I mean, we just had a hurricane, right? Small little here. What was it, Hillary? That stems a lot of claim activity. So in the last 5 years, the claims that we've paid out of, we've burned what I think it was like 10 million acres of land, but we've actually lost 25 years of underwriting profit in the last 5 years. Think about that. 25 years of underwriting profit and 5 years of loss. And they're saying climate's not changing, risk isn't changing. So they don't want us to model based on the last 5 years of data. They want us to use 20 years of data. That's not realistic. And that's why we're in this insurance pandemic.
Understood. Yeah. Let's focus on a little bit on covered California plans. In the past, you would not write them as much because, there was a lot of admitted carriers. But today, we're seeing a lot of, the deals I'm doing and stuff. You're seeing a lot more of covered California. What is going on with that?
Yeah, so CFP, California Fair Plan, is a product derived by the state, right? It's a state product. It's supposed to be the last insurance option, which means if you go to an admitted carrier like State Farm or Farmers and they can't write it, then you go to like the not admitted carriers and they say no, then you're supposed to go to Fair Plan as the last choice. Even they disclose us with a lot of legal disclosures and say use Fair Plan as the last choice. Unfortunately, in this market, it's becoming the first choice. And what happens is it's only coverage for fire, wind, and your personal contents. So no water damage, no liability, no theft, none of that other major coverages of the things, the risks that we face every day, right? So what happens is you have to write with Fair Plan as your last resort for just fire coverage, which first of all has a max of $3 million of total coverage. So think about where we're located. Calabasas, I do a lot of insurance in the local community. The houses are 10,000 square feet, 8,000 square feet. You cannot rebuild a home for $3 million. So if you go to them, which some are, you're actually underinsuring a property. And there's a clause in that Fair Plan that states if you're not 80% covered for replacement costs, the policy won't pay. They don't even know that. So a lot of these brokers or agents are selling, unfortunately, because they have no other product to sell. Fair Plan as its first choice, which is a no-no. And the Fair Plan actually is stating we can't take on all this risk. Their submissions have gone up by over 300%.
Wow.
300%. And so they're like, no, we need to slow this down. Like, this is not a first choice insurance, this is the last choice. And unfortunately, right now, that's where everyone's going because it's very hard and expensive to find traditional coverage in this market.
They also pair the California Fair Plan with a supplemental insurance?
You're supposed to. So they call it a difference in conditions, DIC, or companion policy. That's the verbiage we use. What that means is you do Fair Plan for your fire coverage, and then you get your companion difference in conditions to get the other coverages like liability, theft, water damage, right? And you would be pretty insane to not purchase a difference in conditions, right? Some people are like, I don't want to spend the money because now I'm paying for a Fair Plan and a difference in conditions. But the reality is a water damage claim is more common, is the most common loss that we face every day. So a pipe flooding out your house is more common. Obviously a fire is more expensive, but the more common ones, I mean, nowadays one pipe breaks, it's $100,000 to $300,000 to repair your house. Flooded walls, flooded the wood's gone, everything's just wet. And water gets in everywhere. So you gotta purchase a difference in conditions policy to give you that full coverage package that you need. And liability, because as a homeowner, you have an asset to protect. And that liability piece is important because if somebody slips and falls on your property or sues you for something you're liable for, you need to have that protection, and you don't get that in a Fair Plan.
Are you able to get an umbrella policy?
We can't write one right now with State Farm because that falls under a general, but I always highly recommend what's called a personal liability umbrella policy. That's an extra layer. So it's basically you have your auto exposure and you have your home exposure, or even renters if you're a renter, right? You still have exposure. That gives you extended coverage on top of your liability limits on your auto insurance. So like, for example, you get in a car accident, maybe you injure somebody. Maybe their injuries nowadays, medical is very expensive. $500,000 that you're liable for, but you only have $250,000 of coverage. If you don't have an umbrella, you're going to pay Kamyar out of your pocket another $250,000. I'm sure you don't want to pay all that hard-earned money to protect it, right? Well, the easiest, cheapest way to do that is with an umbrella. On average, it's like $30 a month for $1 million of coverage. So an extra $1 million put aside for you at $30 a month to protect what you worked hard for.
Makes sense.
Yeah.
What is a personal articles policy?
So yeah, one of the things I really miss writing. So State Farm has a standalone, what's called personal articles policy. That's a floater that protects like jewelry. So like your watches, your diamonds, your necklaces, your artwork. If you have some people like Persian rugs or like those fine rugs, we can do memorabilia, we can do like statues. So in homeowners insurance, you're very restricted and limited to those high valuables like jewelry and fine arts. So for example, most companies max is only $2,500 per one item, a maximum of $5,000 for theft. I'm not talking for fire, because that's your personal property when your house burns down. But the biggest thing is the crime's on the rise, and so theft. So if you're a watch person or your wife has beautiful diamonds or whatever, you want to protect those with a personal articles policy. I can do a zero deductible, for example. So if your house gets broken into or you're out wearing it at a nice dinner, somebody robs you, you have extra layer of protection to give you full replacement costs of that item.
Any other thing we should be aware of what's going on in the insurance industry, you know, the goods, the bads? Where do you think this is all going to?
I think first of all, number one is be educated, be patient, and understand because, you know, in the world, if you're buying something, goods, and you see something that's $20 and something that's $100, you're always going to say, oh, that's why 5 times more expensive. But the quality of what you're buying and understanding the product that you're buying and what you're buying is what you need to be educated on. So I think just be patient because right now it's a tough time, but I can assure you we'll get through it. Just like any other thing we've done in this world, right? Things are cycles, right? Industry goes up, but even in your industry, interest rates go up, they go down, people are happy, people aren't happy. It's uncontrollable. So let's focus on controlling the controllable, which is getting educated, being patient, understanding who you're doing business with, and have a true advocate that looks out for you. So like an agent like myself has a lot of value, right? You purchase the product. Like I say in my joke, you get me for free. But really, you have me working for you and my team because I don't work for State Farm. I'm an agent owner. So that means my customers, I work for you. So you want that go-to guy that's going to give you good advice, not just sell your product because he wants to make a commission. Really look out for your best interests and that you have proper coverage because one loss literally can wipe out all your assets. And so it's about having somebody to go to in your corner.
As a State Farm agent, you can only write State Farm products.
Yeah, so we're considered what's called captive. Captive means we're just restricted to State Farm portfolio and its affiliates that we do business with because some of our products are not State Farm. Like, for example, we partnered with US Bank for our banking products, Jackson National Annuities for the annuities, but our core products is all State Farm, right? So we can't broker like a Farmers. They have the opportunity to broker with some other companies to write non-Farmers business. But yeah, we're captive at State Farm.
When is the last time State Farm had a moratorium on its products?
The only time we have moratoriums, which is normal, is when there's an earthquake, right? You have like a 5.0 earthquake somewhere up north, and they might put a restriction on local zip codes. So that's a moratorium, right? So that's when we'll get one. But I've been doing this 13 years. I've never seen a hold. As far as I know, only the last time I heard a hold was after the 1994 earthquake. And the reason is that the earthquake hit in Northridge and it was a lot of claims. In order legally to not offer earthquake insurance, because the earthquake was not a separate policy, it was endorsed within the company, which means the company provided the coverage. Now you have California Earthquake Authority, which is a whole different subject. So in order to not offer earthquake on their policy, they had to start writing homeowners. So every company said, we can't afford earthquake anymore. So they all stopped writing homeowners at that time. How long, I don't know, but that was probably the last time that they put a true hold on fire business.
Do a lot of people obtain earthquake insurance?
Yeah, I mean, I got my handful. I would say it's a 60-40 split. 60% don't, maybe, give or take. Some people don't believe in it. Some people think the deductibles are high. It's a catastrophic policy. And what I mean by that is you're not looking for if you have a couple, like, $10,000, $20,000 worth of structure cracks. You're looking for big foundational issues because if a big earthquake hits, to rebuild a foundation and your home has damage, it could become $1 million like that.
Plus.
So is it expensive to have it? It's more expensive to not have it.
All right.
Yeah. And that's what insurance is. It's a what if. But that what if, when it happens, gets very expensive.
Very expensive.
Very expensive. I mean, like I said, I've seen claims be millions of dollars.
Right.
And so if you don't have the right coverage, they can garnish your wages. They can attach a lien on your home if you own a home. The law states they can take 50% of your income for 10 years and then renew it again for another 10. I don't want to give that power to a judge to take off what I worked hard for. So insurance is the way to protect yourself.
Well, thank you, Mike, for coming on the show. Thank you for all the valuable information, and I will be seeing you soon.
I appreciate being here. I appreciate, like I said, thank you for your trust, your friendship, of course, as well. But we appreciate you. So thank you.
Sounds good, Mike.
Yeah.
Thank you.
My pleasure.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.